My name is Larry Haven. I'm a professor emeritus of industrial relations at St. Mary's University. Welcome to all of you to the webinar called The Political Economy of the Pensions Crisis. The webinar series, as many of you know, is sponsored by the Canadian Industrial Relations Association. And I encourage those of you who are not yet members. You don't have to be an academic. You can be a practitioner. Anybody with an interest in labor relations is welcome to join CIRA, and it's www.cira-acri.ca. So our speaker today is Hugh Mackenzie. Hugh, you'll fill in if I miss a couple of points, but Hugh is a former economist with the United Steelworkers Union, and he's written extensively for, among others, the Canadian Centre for Policy Alternatives. You may be familiar with his wonderful annual series about the difference between the rich and the rest of us. Especially one of the ones where he did this wonderful graphic representation of him standing on a stool and the CN Tower representing the difference between the average Canadian wage and that of the of people much richer than the rest of us. In recent years, Hugh has become very interested in pensions, and I was searching today for somebody who could talk not only about the details of pensions, but about the broad political economy aspect of pensions, not only public pensions, but private pensions as well. I was originally going to call it, Will There Be a Pension Plan When I Grow Up? But Hugh reminded me that that implies that there are good pension plans for some people. And in fact, a lot of those pension plans are being eroded. So having said that, I'll let Hugh begin. What we're going to do is Hugh's going to speak for a little over a half hour, and then we're going to open it up for questions. Just to remind you that because this is a go-to webinar, the way it works is that Hugh is the panelist. You'll be able to hear him and me. The rest of you are muted. When Hugh is finished speaking and we open it up for questions, please indicate your desire to speak, and I will try to get to you in order of when you put your hand up, and then I'll unmute you. You get to speak. You don't. This type of webinar platform unfortunately, does not allow your picture to be shown, but it will allow your voice. So. And I'll repeat that at the end of Hugh's comments. So I'll pass it over to Hugh.
Thanks, Larry. Thanks to everybody for joining. As Larry said, I've got a few slides that I want to take you through, and you'll notice that most of the slides are pictures. It's because I like to tell stories with pictures. To focus on a word at the outset, you'll notice that the title page puts the word crisis in quotes, and that's not meant to suggest that the current situation with respect to pensions in Canada isn't bad. It's more to get at it's more to make the point that if this is a crisis, it's incredibly slowly moving. As we'll see when we start to look at some of these pictures, the issues that plague the Canadian pension system have been around for a very long time, and the length of time is essentially related to our collective unwillingness to acknowledge that there's actually a problem with the underlying system. So let me get started. Assuming that I can figure out how to make this work. So here's an outline. I'm going to talk a little bit about the current state of workplace-based pensions in Canada, refer to some of the general pressures on pension plans and frankly on other retirement income savings, a comment on the, some comments on the relationship between DC and private savings plans and defined benefit plans, and then shift to some brief comments on what I think we might do to address these sets of issues. So first of all, just looking at the general pension coverage environment, over the last 40 years, there's been a steady decline in the percentage of the workforce that's covered by a pension plan. But it's important to note that that decline is almost entirely restricted to the private sector. If you look at the data, coverage of employees in the public sector in pension plans varies from province to province, but overall across Canada, it's been essentially in the 75% range for pretty much as long as consistent data have been collected in the mid-1970s. There's been, I think it's fair to say, a collapse in coverage, in retirement income coverage in the private sector, and that collapse is concentrated in defined benefit plans. And there's a bit of a tendency in discussions of pension policy to observe that decline and then jump straight to, well, what can we do to make the decline go in the other direction, to reverse it? In my view is it'll be obvious by the time I'm finished here. I think that's a bit of a waste of time, because I think it's really important to understand why these developments have taken place. And so that's what I'm going to focus on for the next couple of minutes. First of all, just the basic facts. The chart that's in front of you now shows the percentage of the paid labor force that is covered by a pension plan of any kind in the private sector. And it shows it declining from a little over 35% in 1977 to barely over 24% in 2010, and it's continued to decline. There's a couple of important takeaways from this chart. One of them is that there's been a significant decline in pension coverage, and we can shift gears in a few minutes to think about why that's been the case. But the other thing that I think is worth noting is that I think it's fair to say that most people would describe the mid-1970s as kind of the heyday of the private sector workplace-based pension system, and I think it's worth noting that even in that heyday period, coverage was never substantially more than a third of the workforce. So I think one of the points, one of my key takeaways from these numbers, from these charts, is that that although the private workplace-based system was originally conceived of as one of the three legs of the Canadian retirement income stool, it's never actually fulfilled that role. It even at its peak, as I said, it only covered barely over a third of Canadian employees in the private sector. And when you turn to the situation as it relates to real pension plans, as opposed to DC arrangements, which are essentially a form of tax-assisted savings, as opposed to creating a pension plan, the decline is equally dramatic, and in relative terms, much more dramatic, dropping from just over 30% of the paid labor force in the private sector in 1977 to around 12% in 2010, and as is the case with overall coverage continuing to decline. And I think it's worth noting that even that that rather dismal 12% range number, which translates to about 1 in 8 private sector workers, actually overstates the situation as we contemplate looking forward for a couple of reasons. One is that although it's hard to find good numbers, my guess would be that probably close to half of that 10 to 12% number describes workers in the private sector who belong to multi-employer plans, largely in the construction sector, but also in other sectors. In other words, they're not the traditional sole employer-sponsored defined benefit pension plans that unions like the steel workers and the auto workers used to be able to negotiate. And the other thing that's worth noting about that 12% number is that includes private sector employees who are active members of closed plans. If people who follow this relatively closely, for example, will know that the big pension plans in the auto sector, the auto assembly sector, are now closed to new entrants. The pension plan, for example, for the steelworkers in Sudbury at Inco, those plans are closed to new members. Most of the banks have closed their defined benefit pension plans to new members, with the notable exception of the defined benefit pension plans that they create for the chief executive officers, which they continue to be willing to support. So that in fact, the 10 to 12% number actually overstates the prospects that we're facing in the intermediate future for the defined benefit pension system. So I think one of the critical questions that we need to focus on is why. And there's some of these changes really are really driven by structural changes in the economy. For example, there has traditionally been a very strong relationship between union representation and the availability of pension plan membership in the private sector. And as union density in the private sector continues to go down in Canada, that impetus behind defined benefit pension plans in the private sector has diminished dramatically, if not disappeared in some instances. So that's one of the drivers. The other key thing is that there have been changes that have taken place in the more broadly based economy that have created very powerful incentives for employers to get rid of defined benefit pension plans and shift to DC or get rid of defined retirement savings plans entirely. There's been an increase in the rate of turnover of employers. Employers in Canada, post the free trade agreements, are much more heavily exposed to competition from similar employers in other countries that don't face the same pension obligations that Canadian employers do, because their retirement income systems are more heavily public than they are in Canada. So there are a number of sort of broader economic factors that are pushing private sector employers away from defined benefit pension plans in particular, and retirement savings arrangements in general, that are externally driven and really have nothing to and really offer not much of a prospect of reversal. In other words, the decline in pension coverage in the private sector can't really be, you can't really sustain the argument that this is because employers in the private sector have suddenly become bad people, and if we just made them nice people, we'd get a recovery of the pension system in the private sector. I noted that in addition to simply wiping out defined benefit arrangements, employers have been shifting from defined benefit arrangements into defined contribution arrangements, either through registered DC plans, but more commonly by creating what are described as group RRSPs, which are essentially defined contribution pension plans that get around the requirement to register DC arrangements by making them individual RRSP accounts. There's a lot of research out there on DB versus DC, and including some really terrific work that's been done recently by a Canadian academic actuary named Bob Brown, who has done a significant report on the DB versus DC issue, specifically with respect to plans in the public sector, but the same arguments apply in the private sector as well. And at the risk of becoming economisty in my thinking about this, the DB versus DC debate really boils down to, from a societal perspective, boils down to an issue of efficiency. DC plans compared with DB plans are inefficient in providing retirement income for two primary reasons. One is that the empirical data show that partly because of the high fees that are charged for managing money in individual accounts, and partly because investment performance generally is weaker than it is in defined benefit arrangements for some technical reasons that we could get into. A significant proportion, the DC arrangements are simply inefficient as a way of setting aside money for future use in retirement. A calculation that I've done, which replicates calculations that others have done looking at the same issue, concluded that I concluded that if you made some reasonable assumptions about regular saving during a person's working lifetime, assumed that the proceeds of that saving were invested in an RRSP in Canadian mutual funds with a kind of traditional 60-40 equity debt split, that roughly 45% of the savings, of lifetime savings, would end up in the hands of the mutual fund managers in the form of fees rather than contributing to the individual's retirement income. The evidence is clear that large DB plans earn better returns than large DC plans, and that large DC plans earn substantially better returns than individual retirement accounts. On this slide, I go through some of the detail, which I'm not going to get into in any great detail. But suffice it to say that a significant piece of the advantage for DBs over DCs is fundamentally related to the structure and purpose of a DB plan as opposed to a DC. Specifically, one of the characteristics of a defined benefit plan is because people stay in the plan through their working lifetime and then in retirement, the plan itself overall ages, if at all, very slowly. And so that means that DB plans tend to have much more aggressive investment management objectives than DC plans, and that produces higher notional savings for retirement in a DB plan. And the other major advantage of DB over DC is that the arrangements for risk sharing in a DC plan are the most inefficient ways of managing risk that you could possibly conceive of in a retirement income system, because what a DC plan does is it shifts both investment risk and longevity risk onto the individual retirement saver, who is the least able to bear that risk, because the individual has no ability to pool the risk over anybody. And the best image I can think of for describing this is that if you imagine, instead of a pension plan, you think of a dental plan. If you go onto the web and try to price out a dental plan as an individual, the price that you will be quoted is significantly greater than it would be if you were getting a quote for a group of 100 or 200 or 1,000 people. And that's simply because there's more people to spread the risk over. So the larger the group that you can spread the risk over, the more efficiently you're going to be able to manage the risk. And that's a huge advantage for DB plans over DC. There are also some other issues that are kind of overarching issues that are affecting the economics of all pension plans and defined benefit plans in the private sector in particular. The next chart, the chart that I have up now, shows life expectancy at age 65, which is a crucial measure, a crucial metric for Canadian pension plan, for any pension plan. And what I'd like to draw people's attention to is, well, there's a couple of remarkable things about this. This is drawn from StatsCan life expectancy data. And what I find really interesting about it is two things. One is that, amazingly enough, male life expectancy in Canada didn't reach the level that it hit in 1900 again until the early part of the 1970s. So it took 70 years for male life expectancy at age 65 to get back to where it was in 1900, which is a pretty remarkable number. But the other thing that I want to, the other aspect of this chart that I'd like to draw attention to is that you'll notice, if you focus on the period around 1965 and think about the designers of the Canadian retirement income system in the mid-1960s, thinking about the world that they were facing. They were looking at a world in which there had really been no significant improvement in male life expectancy for about 60 years, no substantial improvement. And while there had been improvement beginning with women, in the mid-1960s, the participation rate of women in the labor force was only about 30%. So you can imagine that the designers of the system had a pretty sanguine view of what the implications of increased longevity were going to be for pension costs. You look at the telescope from the 2005 end, and you can see that that was clearly wrong. And there have been significant increases in life expectancy at age 65, which have significant implications for the long run cost of pension plans. The second chart in this series that I wanted to put up looks at some data from StatsCan, again going back to the mid-1970s, that looks at average job tenure by age group. And this is one of those things that actually kind of surprised me because I had I had convinced myself that that one of the fundamental characteristics of employment in the post 2000 period was a dramatic increase in job churn. And what this chart says is that there actually hasn't been that much change. And to the extent that job churn is a problem for individual employer-based retirement income systems, job churn has always been a big problem. Or another way of looking at it is to say that even if you go back to the heyday of the private sector pension system in the mid-1970s, I think it's fair to say that these numbers indicate that the system has actually never done a very good job of responding appropriately to the realities of the Canadian labor market. There's always been a lot of churn. there has always been a lot of sort of orphaned pension arrangements. Now I'm going the last thing I'm going to focus on here is what is it? We've talked about longevity. I'm going to talk a little bit about what's happened to prospects for investment returns. And here the key metric to look at is what are we likely to expect over the next 15 to 20 years as an underlying real rate of growth in the Canadian economy. The first chart, I think, shows pretty conclusively that in the period between the mid-70s and just after the year 2000, that there was a significant contribution to the growth rate of the Canadian labor force from increases in the rate of labor force participation of women. Between the mid-70s and 2000, the participation rate of women increased from just over 50% to in the mid-range between 75 and 80%, to nearly 70%, and really started to approach the participation rate of men to an extent that is really unprecedented. And my point in putting this slide up here is to demonstrate that the increase in labor force participation that contributed so significantly to Canadian growth in the 30-year period between the mid-70s and the mid-2000s is gone. We are not going to see any significant contribution to Canada's future economic growth from labor force participation. And that's reflected in the next chart, which shows the labor force growth rate. And the numbers that we see for the year-to-year labor force growth rate in the 2000s are consistent with the numbers that you get when you look at StatsCan's population projections. They suggest that over the next 15 to 20 years, we are realistically looking at a labor force growth rate of somewhere in the range of 0.8% to 1%. A far cry from the much larger rates of growth that we saw in previous years. And we've also seen that there's now been a stabilization in the percentage of the labor force that's made up of part-time employment after a period of growth in part-time employment that went sort of continuously from the mid-70s to the 90s and was to a certain extent cyclical. It's now stabilized at somewhere around 20%. So you're not likely to see much going on in the growth story on the part-time versus full-time front. One of the few things in economics that might actually be described as an identity is that the underlying real rate of growth in the economy is the sum of the labor force productivity growth and the rate of labor force growth. And you can see from this chart that that assumptions about productivity growth that are anywhere in excess of 1% a year are not really supported in the data that we see looking back over the previous 40 years. So if you put the labor force numbers together with the productivity growth rate numbers, you're looking at underlying real growth rates over the next 15 to 20 years of about 2%. And that compares with real growth rates in the previous 20, 25 years of north of 3. So there, and that will inevitably translate to the kinds of things that you could expect in investment returns. that point is reinforced in the next chart, which shows the long-term real return bond rate in Canada going back to 1991. And you can see for the first sort of 10 years of this chart, the results in the RRB yield numbers of the fact that that decade was the end of a 2-decade period in which real interest rates in Canada, in fact in the United States as well, were well above historical norms. And we've now reverted back, in fact, not just to historical norms, which had been in the 2 to 3% range, but actually well below that. That's a lot of that is driven by monetary policy, but I think it's reasonable to expect that those real return numbers are not going to be much in excess of 2% for the intermediate future. And so the implications of all of this, I think, are that there's really no prospect even for an end to the current trend of declining pension coverage in the private sector, much less a reversal. Shifting the focus back to that chart about labor force turnover, I mean, even if we could reverse that trend, even if individual employers did start to reestablish defined benefit pension plans, it's not clear that that would be desirable, given the fact that that people just don't stay with the model in which the private workplace-based pension system is based, that somebody will work for a career for one employer and then retire from that employer, is not typical of the typical Canadian worker, not characteristic of the typical Canadian worker, and probably never has been. Certainly hasn't been in the period since the mid-70s. As I pointed out earlier, the current trend amongst major employers of freezing or closing current DB plans and either ending pension coverage entirely or shifting to DC is only going to make matters worse. And the alternative that's out there, savings-based systems, are just so hopelessly inefficient that it just does not make sense to imagine that you are going to replace or offset the decline in private sector workplace-based pensions through things like RRSPs or the PRPPs, which are essentially just jumped up RRSPs structured so that insurance companies can participate. The fundamentals of those systems, that the returns are low and eroded significantly by high fees, and that the allocation of risk in those systems is hopelessly inefficient, those fundamentals aren't going to change. Which leads me to the conclusion from this analysis that really the only viable workplace-based retirement income system in Canada right now is the Canada Pension Plan. Several years ago, I gave a talk for the Association for Canadian Pension Managers at their annual conference, and the presentation was similar to this, and I ended the presentation with a rhetorical question. I asked the question: imagine a 25-year-old woman joining the workforce, and ask yourself the question: what kind of pension plan, what kind of retirement income arrangement would be best for her? And the answer to the rhetorical question is that the best pension plan for her is a pension plan in which all of her future employers are participants. Because otherwise, her pension, to the extent that she's even lucky enough to get a pension, it's going to end up being fragmented. And I sort of paused at that point, and then I said, you know, we actually have one of those. It's called the Canada Pension Plan. And that's what leads me to the conclusion that if we're serious about focusing on rebuilding and re-strengthening Canada's retirement income system, that's where we need to focus our efforts, because that's further expansion of the Canada Pension Plan is really the only viable option for for dealing with these issues, and that is going to require a degree of political will that I think is fairly significant. I was encouraged by the fact that pressure developed on governments across the country to improve the Canada Pension Plan so quickly. I would be really surprised if this is the last time we have a conversation about improving the Canada Pension Plan. But I also think that in our future conversations about retirement income, we are going to have to shift our focus again, as we did in the 60s. We're going to have to shift our focus to pension plans that are not related to workplace attachment as well, both for some of the reasons related to the future of work, but also because we're starting to see evidence that the old age security and the guaranteed income supplement, which are the universal plans, are increasingly starting to leave seniors in a level of poverty that I think Canadians would consider to be unacceptable if they thought about it carefully. The point of the chart that I conclude this with, it's a bit of an occupational hazard of mine because I spent a lot of my time thinking about fiscal capacity, is just to note that it is simply not true when people say that we can't afford to deal with issues like the aging population and the healthcare implications of that and the pension implications of that. I think it's worth noting that since in the 15 years, in the 25 years since 1991, taxation as a share of GDP in Canada has dropped from just over 31% to 26%. 5% of Canada's 5% of GDP is a large amount of money. Certainly enough money to contemplate making a serious attempt to get at the implications of aging for aging Canadians.
Wow, thank you, Hugh, so much. This is wonderful. I just wish this webinar could be 2 hours. But just to remind people that there will be a recording, or this is being recorded. You won't be able, in the recording, you won't be able to see Hugh, but you'll be able to hear him and see the slides. Before we have questions, I just want to turn this over briefly to Lorenzo Frangi to give you more information about some things that are coming up with the Canadian Industrial Relations Association. Lorenzo.
Yes. Hi to everyone, and thank you very much, Larry, for organizing this webinar, and thanks a lot to our guest lecturer for such an interesting presentation. Just briefly, I would like to remind to everyone that CIRA is organizing the conference next year, early May, in Montreal at the UQAM, at the School of Management of UQAM. So the call for paper is already available in our website, and the deadline is January 18th, as well as the form to submit your proposal is already online and simply available. Moreover, I would like to remember that there are 2 student awards for the best paper. One is the Alan Ponak Best Student Paper Award, and this year we also have a new award, is the Law of Work Award to encourage outstanding scholarship in Canadian employment and labor law. More last information is that CIRA this year has also webinars in French. We have more or less 1 per month a webinar on Friday morning at 8 a.m. Montreal time, once per month, the first Friday of each month. You can find the program on our website, and it's very simple. If you want to join the webinar, it's just to click on the link that we have on our website at the page for the webinars in French.
Thank you, Lorenzo. I have a question from Carmen Kachuk, who doesn't have a mic, so I'll ask the question. And it's, Hugh, why do most of your data sets end 2010 to 12? And this, just a reminder to the rest of you to put your hands up. You'll see on the control panel there that you have for a GoToWebinar an opportunity to put your hand up asking if you have a question. Hugh.
It's partly data availability and partly my own fiscal capacity. The data on pension coverage ended in 2010 because it's a custom run that I bought from Stats Canada out of my own money. It cost me $600, and I didn't really feel like spending another $600 to update it by 2 years. So that is no great cosmic reason for those things to end at that point. If somebody were to come along and say, Hugh, you can have $600 and get Stats Canada to update those data, I'd be happy to do it.
I understand completely. I've just been doing just asking for custom runs from Stats Canada for another issue entirely, and of course, every couple of years, whenever there's a census, you want the information, and it costs. So thank you, Hugh. I may not get this in the order that they were asked, but I'm just looking at the questions. The first one I have is Andrew Stevens. Andrew. Andrew is self-muted. Andrew, unmute yourself. Oh, now you're unmuted.
Can you hear me?
Yes.
Okay. Well, thank you very much. This was very informative. This has been a perennial issue in my faculty association specifically, but very enlightening in terms of looking at the bigger picture of pensions. I'm curious, I mean, what you've presented here is a larger political economic question. Do you have any advice to lend to rank and file activists and union members in terms of how do you confront your employer in a collective bargaining capacity to shift gears here? About 17 years ago, for whatever reason, my colleagues gave up our defined benefit plan. What do we do next? How does one move from the privatization of pension plans vis-a-vis defined contribution plans into a bigger Canada pension plan system? Is this a matter of actually just rolling all these private into the CPP? Any kind of like workplace and bigger economic strategies you could lend to this conversation would be super welcome.
Yeah. That's an interesting that's a really interesting question. I was engaged a couple of years ago fairly intensively in the discussions in Ontario about the Ontario Retirement Pension Plan, which actually ended up providing some of the political impetus behind the expansion of the Canada Pension Plan. And one of the arguments that I made in that context was that if Ontario was going to set up a public pension body, that it ought to include in it the potential to be a home for orphaned commuted values out of closed DB plans or out of the or commuted values that are received by pension plan members who quit or are otherwise terminated, as a way of converting DC balances into a DB plan. And so it's at least in theory possible that a future expansion of the Canada Pension Plan could provide the option of allowing people who are in DC arrangements now effectively to bypass service, to buy additional service in the public plan. With respect to people working in individual workplaces, a couple of thoughts that have occurred to me and that actually emerged from my own experience. One is that it's always open, and in fact, this is a fairly common trajectory for DC plans. It's always open to you to negotiate a floor for the benefit. So effectively to force the DC plan into a hybrid system by negotiating a minimum benefit. And that's actually been a trajectory in some cases. So there's been a DC plan created, and then as it's become clear that that plan is not generating adequate retirement incomes, a floor is negotiated that sort of acts as a buffer against the collapse in the values. A second strategy that I've actually helped to enable in a specific instance is an employer has put a DC plan onto the table, and the union has responded by saying, give us the money and we'll create a target benefit plan. So in other words, we will as far as you, the employer, are concerned, this is a defined contribution plan. The contribution is defined in your agreement with us, and we, the plan members, collectively will bear the risk, and we will organize a pension plan. We will organize something that delivers an actual pension benefit. That's actually not possible legally in most parts of Canada, but in the instance that I'm thinking about specifically, I ended up finding 2 or 3 groups that were in exactly the same situation, and they have gotten together and created a multi-employer plan. It's kind of an unusual multi-employer plan because it actually doesn't arise from a single master collective agreement. It arises from 3 or 4 individual collective agreements, all of which give rise to defined contributions into a fund, which the unions end up being able to control the use of. So, so trying to find some way of pushing DC arrangements into some sort of a target benefit arrangement or a multi-employer plan, I think is a viable alternative strategy.
Okay, thank you, Andrew. The next questioner is Denise Nelson. Denise, are you there? Denise, are you there? I noticed her hand went down, so we'll move on to the next questioner, which is Kevin Scarrett. Kevin, are you there? We can hear you. Kevin?
Kevin, are you there?
Hello, I'm sorry. Can you hear me?
Yes.
Yep.
Okay. So thank you, Hugh. I'll just say quickly, I think your point about expansion of CPP and this should be remaining on our agenda is very persuasive. Totally agree. I'm interested in your thoughts on the implications of expansions of CPP being required under the current rules to be fully funded. And if there was a further expansion beyond what happened in 2016, we're talking about really a massive investment fund, many times larger than the current very large one. And I see that as problematic, particularly given the direction of the CPPIB and other large funds looking to buy up public infrastructure in Canada and around the world. So I'd just be interested in your quick thoughts on whether or not a further expansion of CPP should be done on more of a pay-as-you-go basis, partly to avoid these the negative implications of these massive funds.
Well, there's 2 negative implications of the approach that's been taken. One is the one that you raised, that I think that I don't know, quite apart from the actual detailed investment strategies, I don't know that anybody has a definitive answer, but I don't think there's anybody out there who doesn't believe that at some point there actually get to be diseconomies of scale from these very large funds, that they just get so big that they have trouble finding reasonable investment opportunities that actually move the dial in the performance of the fund. So I agree with you on that, but I think the bigger problem, in fact, is that by requiring full funding in advance, which is completely unnecessary in a universal public plan, by requiring funding in advance, you are effectively delaying the impact of any improvements excessively. I'm not sure that that we would necessarily, in improving the Canada Pension Plan, create as good a deal for initial participants as we created when we created the Canada Pension Plan in the 60s. But I think that somewhere between immediate benefit and having to wait for 25 years before it really has any impact, there's maybe a sweet spot. And what I find frustrating about the full funding in advance movement is that after a lot of gnashing of teeth and political to and fro, on the main Canada Pension Plan fund, we actually solved, I think we came up with a good solution to the reality that labor force growth has dropped to the point where a pure pay-as-you-go system can't really work. You need some sort of a fund to ensure sufficiency in the long term because of the demographic realities that underlie it. But I think we solved that problem. And the actuary is now saying that the Canada Pension Plan already has the current funding system has a very long time horizon already, and it's not nearly fully funded. I don't know why we couldn't have just replicated the same thing. Larry, I've lost the sound.
Oh, sorry. That's me. I muted myself. Thanks for reminding me. Okay. Our next speaker is. Yeah, that's right. Sergio Balaj, are you there? No, I guess not. Let me just see if there are any other questions. Do we have another question from Kevin Scarrett? I see a question mark.
No, sorry. I don't know if I clicked something, but no, I appreciated Hugh's answer.
Okay.
Thanks for the.
Okay, thanks. Hugh, do you want to just wrap up and also indicate to people where they can read? I know you've done a number of publications about pensions. Just before we exit, can you tell people where they can access it, and then we'll draw this to a close.
Sure. Well, concluding comment just to really reiterate basic points from an industrial relations collective bargaining perspective. I think the prospects for rebuilding Canada's retirement income system as it relates to workplace pensions through collective bargaining in the private sector is pretty limited. There are some options options that might get you to a decent second best, but certainly not a lot of prospects for dramatic improvements in the or dramatic reversals in the current state of decline, which means that we really need to turn our attention to the Canada Pension Plan. And to Kevin's point, I think we need to address the reality the current plan is so far deferred into the future that there is going to be a generation of retirees in Canada who did not benefit substantially from the 20-year period of extraordinarily high investment returns in the 80s and 90s, who are going to be retiring with very low pensions and have no prospects of being able to latch on to the Canada Pension Plan benefits. So I think in the next round of Canada Pension Plan expansion discussions, we need to focus not only on coverage and replacement rates, but also on the timing of implementation, because I think what we've got now is just too deferred. With respect to where you can find more detailed stuff, I just recently did a piece for the Manitoba Federation of Labor, which is on the Manitoba Federation of Labor's website and on the CCPA's website in Manitoba, on the state of pensions in Manitoba, which deals with a lot of these issues. A few years ago, I did an extensive piece for the Labor Management Institute at Ryerson. That's still available on their website. And I did a lengthy piece looking at the state of private pensions in Alberta around the same time, and that's available on the Alberta Federation of Labor website. There's other stuff that's floating around on the CCPA site as well, but those are the main big things that I've done.
Okay, thank you, Hugh, so much. This wonderful presentation on a very important topic. Before I go, I just want to remind people that there will be at least one more webinar. We're thinking about the topic, what's the difference between $15 an hour minimum wage and a living wage, which is a very interesting topic. Also, if any of you have suggestions about topics for webinars, please get in touch with me. It's larry.haven at smu.ca. So thank everybody for attending today, and I cannot send you the recording by email because it's too large to be sent, but we'll try and get it up on the CIRA website so that you can download it. Thank you all again. Bye-bye.
Thanks, everybody.
Bye-bye.
Bye.